Good morning and welcome to Stock Talk. My name is Morgan Lee. I'm the analyst on the technology team. Joining me today is Ami Joseph, Sector Head of Technology. Ami, take it away.
Thanks, Morgan. Welcome, everybody. We're excited to be here. The last time we were here, we had a good time talking about DRAM and talking about Micron. We talked about IBM, Red Hat, and a few other fun stocks. Today, I thought I would address a subject that people lately have been asking me a lot about, which is the recent pullback in tech. We call it the computer crash because basically more and more of the stocks that we follow are owned, and their ownership are owned by quant funds, meaning that the buyers of those stocks are using algorithms to systematically buy and sell equities. The reason why we call it a computer crash is simply because so many of these algorithms are similar. They have momentum biases for the most part. And so when they sell, they all sell together. And when they buy, they all buy together. And they end up buying and selling very similar things. So we've had like a little bit of a computer crash since I think it was Friday the 16th of June. So the last 2 weeks basically. And so we're going to look today at a few of the feathers that have been ruffled, or the stocks that are down and up since then, and go through that. So we're just going to jump past our sector coverage, which is on slide 4, and 5 is just some of the new ideas that we're hunting from the quarter that's just ending now. Slide 6 is just a long-term look at valuation. You see that software continues to be the most pricey industry for sub-industry within tech, but also, as you'll see, the most durable, the most resilient. Semi's probably the surprise in there. I don't think if you had rewound 10 years and told investors that semis would reflate from a valuation perspective, I don't think that people would have believed you. So let's get into the computer crash. So that's on slide 8. So you could see since the 16th, since the fall off in stocks, you've had a recovery in software and services. Semis, however, are down. Hardware remains down. Internet is back up. In terms of valuation, again, on the next slide, software has recovered. Semis have not. Internet has recovered. Hardware has not recovered. If I have to overgeneralize from this, I would say the computers were selling beta and keeping growth, or if they sold growth, growth was quickly rebought. That's an overgeneralization, but if you look at semis and hardware as beta, that's kind of like the interpretation that I'm going to gloss this with. Just moving to the next slide, slide 10. What's happened since the Friday crash in terms of performance? Actually, quite a lot. There's a stock up 50% since that crash, which is Synchronos, which had already been down massively year to date, and there's a lot of volatility and event-driven stuff around that stock. So that's even just in the last 10, 15 days, you've got a huge move in some of these stocks. AMD, for example, another one where there was the introduction of a new server chip at the end of June, something that we've talked about on the fundamental side with our institutional customers. We did a presentation on Intel going back just a few weeks ago, and we reviewed AMD, we reviewed their server position, we reviewed Intel's server position. We looked at the areas where Intel was vulnerable. We'll get to one of the two of those potentially a little bit later on in the slides today. On the negative side, you can also see some of the stocks that have been sold. Definitely a chunk of them are either in semis or hardware. Certainly of that list of top 20 decliners over the last couple of weeks, you could see semis and hardware factor prominently. On the market cap side, actually small caps are up since the computer crash, more so than the large caps. So definitely, if the small caps were maybe oversold in that day, they've had a strong rebound. On valuation, going to the next slide, on slide 12, it looks like just a bit more of the cheap stuff was sold rather than the high growth, high expensive stuff. So nothing really to discern in terms of what the computers like or dislike on that side of things. So just kind of, summing that section up, if you're looking at the current pullback in tech as a buying opportunity, you're going to get the most alpha or the most beta in buying beta. You're going to get the most upside now on an upward correction from buying semis, buying hardware. However, you're probably going to, if you look at what happened during the computer crash, where software fell but then quickly recovered back to its previous level, you're going to sleep better at night owning software. You're not going to make as much money in the next just short-term, few weeks trade. But if you're looking for the trade, it's semis and hardware off of this computer crash. If your bias is long, and if your bias is longer term and you want to sleep at night, it's software. All right, just getting into the fundamental side, we're just going to do a quick, kind of give you like a quick snapshot of the things that we look at, the fund that we have when looking at fundamentals. I guess one of the main questions that come to me often from portfolio managers, from my customers, is where do you look for shorts in a market where everything goes up? And that's kind of like a very a question that repeats a lot. So if we look at slide 14, this is an example of the kind of thing that I look for, is where on the left-hand side you can see the year-on-year order growth and revenue growth for a company that we are short, called Keysight, including their M&A, including the impact of the acquisitions that they've completed over the last couple of years. On the right-hand side, you can strip out those acquisitions, and you can see what the company's actually doing from a revenue and order growth perspective year on year. And the two things, even though the actual materiality, the delta between those two things is not enormous, and maybe it's 500 basis points between one point and the other, it's enormous in terms of how people value a stock. And it's enormous in terms of how people look at whether they want to be long or short something. So for example, if they look at the chart on the left, they think, geez, you've got an improving cyclical, things getting better, easy comps ahead, better momentum, right? You're already framing up the language of a long. If you look at the one on the right-hand side, you're thinking, geez, what's wrong with that company? Everything else in cyclical land is actually getting better, and these guys are stunted. And that's the beginning of a short. So this happens to be, like I said, this happens to be Keysight. This happens a lot, and you'd be surprised, at least in the current period that we're in right now, how often analysts and the investor community forget to strip out the impact of acquisitions. It's stunning. You see a company report, let's say, a 15% growth year over year, and the analysts, all they want to do is talk about, wow, what was that? Was it driven by 5G? Was it the better defense orders? And management is so happy to oblige them because it's a growth it's a growth theme and a growth mantra, and it's fun to talk about. It's a good thing for them. It sets them. It changes the conversation to a range of positivity. Almost no one strips out the M&A in that moment and says, hang on a second, you only grew 3% organically year over year, which is a major deceleration. Why is that? Very few people do that. So there's a huge opportunity for shorting stocks like that because the M&A impact ends. And you can know when that ends. And you can see when these companies are going to hit walls where they've promised high growth rates to the street, or where the street has assumed that what was a blended growth rate, organic and inorganic, the impact of real growth for the company and the impact of adding the acquisition, the blended growth rate gets extended into the future, and suddenly when that doesn't materialize, and it's the lower growth rate, it's the standalone company growth rate, when that shows up, people get pretty disappointed, and you can short stocks very nicely on that. Sometimes it only ends up being a relative short in this market because there's a bid for almost every stock, thanks to ETFs, thanks to the passive buying, thanks to People just scouring the landscape looking for cheap stocks everywhere. But it's still, it can also be fun. And we've had fun with it with Microsemi. We've done well with Sabre. Keysight dropped, it was $42 the day it opened up after earnings, and it fell straight to 35 pretty quickly. Now it's back up to 38, so it'll have more opportunities. So these are the kinds of stocks that we look for, the blend of organic and inorganic, and getting to the end of that mixed point. This was, going to the next slide, on slide 15, this was part of the Keysight deck that we did, just to continue on that. I don't mean to beat up one specific stock, but this is another point, so Keysight just completed another transaction. They bought a company called Ixia, and I imagine, I wasn't in the boardroom, but I imagine that they looked at Ixia and they said, wow, this company's revenue's gone from $175 million in 2008 to $485 million in 2016. We need some of that. We need some growth element in our company, and we're willing to pay for it. And so they bought Ixia for nicely over 3 times enterprise value to sales. So like around a $1.8 billion transaction for $485 million of revenue. So it's a pretty rich transaction. The only reason you'd consider paying that kind of multiple is you assume that the company will fill in the valuation thanks to growth. It might take you a few years to harvest it. It might take you 2-3 years or 4 years to harvest the growth. But as long as it's a growing entity, you're thinking that it's okay. I can spend up for control of this growth asset because it's going to grow into its valuation. But when I stripped out all the acquisitions that Ixia has done over the last decade, because it itself has been a very acquisitive company, I realized that Keysight just didn't do its homework, that they bought a company that itself, the core revenue has gone from 175 to 190 in the last 9 years, which, as you can imagine, is an extremely low growth rate. And the rest of it was revenue that was bought. And so they ended up paying for a growth rate that in theory is basically a few guys like me and Morgan wearing our stained white shirts with mustard or Indian food or whatever it is that we're chowing on, sitting there in our desks for too many hours every day trying to make acquisitions, because that's really the growth engine that Keysight hopes to inherit from Ixia, is all the M&A, which of course, as you may know or may not know, the M&A division of the acquired company is the first thing to get stripped out for cost savings. So that's an area to get excited about on the short side, is where you find companies not only that have false growth, but also where they make a dumb acquisition where they assume growth and in the end it's false growth. They're buying false growth. So now you've got 2 problems instead of 1. Just going to the next one, which is slide 16. This is another short for us, which is Intel. And this is an area where Morgan's done a lot of work, so thank you for all the hard work on that. I really appreciate it. This is another area, just from a process perspective. If you're looking for shorts, you look for areas that have already inflated in this business cycle and are facing deflation. So in the case of Intel, as we all know, they had no competition for many years as AMD hibernated, which AMD does from time to time. And during that period of time, you can see that Intel was able to monetize its technology very heavily in the Broadwell cycle. So if you look, there's sort of like an implied price per core in Ivy Bridge. That price per core gets even more attractive with Haswell. If you move over to Broadwell, though, there's a huge inflation in almost like a double of a price per core for the Broadwell cycle, and that's that's now Intel is exposed, right? Now that AMD is back in the market with a chip that is, according to some people, a little better than Intel, according to some people, a little worse. So let's call it even, depending on what workload you need. And AMD is always at a significant discount, historically, always sells their chips at a significant discount. Intel, for example, in the server space sells with an 80 or 90% gross margin. AMD's in the 30 to 45% range for gross margins. So AMD's always sells at a huge discount to Intel in terms of pricing to begin with. And that discount is even more glaring compared to the Broadwell cycle. And so Intel has, in this current Skylake cycle, has to bring the pricing down significantly, the first area being in the desktop area, which is where AMD already launched 6 months ago, launched into the desktop area, is having some success. And in fact, in some cases, having so much success in the desktop area that some notebook makers are using the desktop AMD chip into their notebook SKUs, which is kind of unheard of. So this is another great opportunity for shorting, which is a deflationary scenario. The challenge with shorting something like Intel is that Intel is a part of many different indices, and so it's going to get bought passively as people buy ETFs or buy index funds. So that's a challenge. And then the other piece is that Intel has a 3% dividend yield, which is actually kind of rich. So if you're short, you actually have to pay that dividend yield. And if you're sort of dividend hungry in your portfolio, Intel screens well for you. So you're going to be battling those two things. But it's still an interesting area. We'll conclude with one more Intel slide before we turn it over to Morgan for some of those questions that I haven't seen the questions and I don't know what's coming. So I don't know what they're going to ask me, but I'm not answering any personal questions. So just say that. So this slide 17, it's the last one on Intel, this is the history of the MacBook Pro graphics cards. You could see it oscillates from NVIDIA to AMD and back. The key thing here is that for the last couple of generations, Intel's integrated graphics was good enough to basically run the system. There was still an external graphics card involved, but it was for a reduced amount of processing and workload and usage. The new MacBook Pro, the one just launched, and its predecessor, the one launched previously, I think it was 2016, both are using the AMD Radeon chip to actually run most of the functionality on the board. And so at that point, you've shifted away. Intel Iris is still there, but you've shifted away from Intel Iris from a position perspective. You're definitely leaning on the graphics chip much heavier. They're leaning, in this case, they've chosen AMD twice in a row over NVIDIA. And AMD later this year will have a notebook chip that is integrated into their GPU chip. So it's two chips integrated into one. And if the GPU factor, the graphics factor is so important for the MacBook now, and they're using that as the basis to make a big decision in terms of running so much of the processing of the actual the functionality of the computer. Do they at that point say, wait a second, we can save a boatload of money by also ripping out our Intel CPU and going with an AMD CPU? So this is one of those things where we're sort of watching and seeing whether or not AMD can get into the notebook space. Notebook and server are Intel's two most important areas from a revenue and gross profit dollar perspective. So seeing evidence of AMD break-in will be important as we go through the rest of the year. And I'll stop there. So thanks for your joining us today.
And it's interesting too. We've talked a lot about AMD, Intel. It felt like with the Skylake X launch at Computex, for those of you that were paying attention, those top core chips were paper launches. They didn't feel like they were in the plan. It does feel like Intel is chasing.
Yeah.
And have you felt that before lately?
Not since 2005.
Yeah.
When Intel came out, when AMD came out with was basically suddenly in a leadership position with their Opteron cycle, AMD's chip. Essentially like for 30 years coming up into 2005, the chip war was like American car manufacturers, always trying to get faster performance, more RPM. And then AMD changed the game, and it became performance per watt, which was a smart move because this was when notebooks really took over as the main computing device away from desktops. So you wanted to be able to do a lot of computing, but you wanted to do it within certain battery limitations. So Intel didn't realize this. AMD came out of left field. This was one of those times AMD had been hibernating, and AMD came out of left field with this cycle. And it was definitely like a very exciting time, and AMD gained a lot of share. Intel lost a lot of share, and Intel definitely was sort of caught flat-footed and chasing a little bit.
Yeah. All right. So Thank you, Ami. Awesome. Let's do a quick session of rapid fire questions.
Sure.
All right, here we go. What is your favorite long?
Corning.
What is your favorite short?
Microsemi.
Will M&A continue to rise?
No.
Who is the worst management team?
Microsemi.
Who has the best management team?
Sorry, Sabre is the worst management team. I'm sorry.
Who is the best?
Facebook.
Most bullish space in your sector?
Software.
Best international company?
Taiwan Semiconductor.
Do you think there will be an alternative CPU for the MacBook Pro in the next 2 years?
Yes.
Do you pay attention to macro trends?
Yes.
As an investor, what's your favorite technology upcoming?
There's two. Software automation, which I think is already in play and growing in terms of relevance. And the other is blockchain technology, which I think is going to be pervasive and being used. I don't mean like buying Bitcoins or buying Ethereum or another kind of cryptocurrency. I mean like the actual underlying technology that can create a trusted handshake and with data behind it to examine the handshake between two parties.
As a consumer, what's your favorite technology?
NVIDIA.
For future technology?
Oh.
Upcoming?
Something that hasn't been invented yet.
What was your first dog's name? You said nothing personal, but
no
couldn't
personal.
help it.
No.
All right. So that's it for the rapid questions. We have some really good questions in the queue right now, so let's knock a couple of them over. So, what is a potential catalyst you see down the pike that would get you more involved in Sabre?
I actually want some good news to come my way in Sabre. The more good news, the better. I want some good cyclical data for June, the month of June, and maybe even July. That'll be, the stock will go up on that because 70% of the revenue is still cyclical. So if revenue goes up on 70% of the business, then you get another chance to short the stock. The risk is that I'm playing it too cute, and you have even things like the fact that the biggest decline in the company's customer base on the solution side is already at play, and it's not in estimates for some reason for the second quarter. So I think it could be that I'm just playing it too cute there. Just this is a process word. Whenever you're short something and you get it right and you have success and you see some positives or some positive data coming your way and you want to get out of the way because you want to capture your performance, it's tricky. Sometimes you get that right, and you get it right a lot on the fundamentals, but do you get the stock right? Is a question. Sometimes it's better just to stay with your short if you're convinced that the thesis is still valid and you haven't reached the long-term price target, which for Sabre is in the teens. You stay with it.
Any updated thoughts on Keysight and Ixia in that deal?
No updated thoughts on Keysight and Ixia, but lots of new shorts and longs coming from us over the next several weeks. So.
For sure. Micron, bullish or bearish?
Bullish still. July pricing is up month on month from June pricing 3% or so. To me, that's the tip of the spear. So that keeps the arrow pointed higher. And as long as the month on month contract continues to go higher, the blended quarter to quarter continues to go higher. Incremental gross profits obviously follow pricing almost at 100% rate. And so you still see a continued bullish environment set up for Micron. They actually report later this week. They're masters of pulling defeat from the jaws of victory. So if you get a pullback from earnings on Thursday night, I would just ignore it. I mean, you just pay attention to the direction of DRAM pricing at this point, which is higher. I don't think it'll go that way forever. I think if you look at next year, you'll see a reacceleration of pricing. We got off the Micron train, moved it to the bench just simply because intellectually I was just getting tired of it. And I think at some point that's a fair thing for an investor. We're creative. We need our intellectual cycles to be used for new ideas. We can't just keep cycling through the same stuff.
Yeah. And you and I've talked about too, if memory pricing does start to slow down, so much of their growth last quarter was purely
pricing.
ASP.
Yes.
Music stops, who gets a chair? So next question. What do you think about NetScale and shift to all software based?
I think that the shift to all software, I think the question is about the NetScaler product from Citrix.
NetScout.
Oh, NetScout.
Yeah.
Oh, NetScout, sorry. No comment. Next question.
Okay. Keys, where does it go from here? You've sort of touched on that.
I think if it touches 40 again, I think you load the boat on the short side.
Okay. What are your thoughts on shorting Nokia? Looks like they have a poor balance sheet with pension liability.
They have pension liability. They have a decent balance sheet because they have net cash. They have a bunch of net cash. But their actual amount of net cash is going lower this year as they spend on buybacks and dividends and things that they don't need to be spending on. They have a long road ahead of transformation. They have to do quite a bit of M&A to shore up their product set. They want a number of different reasons, but one of them is, for example, they want to have a standalone software division that is basically like a real software company. They need M&A to do that. They can't do that internally. Nokia is really poorly positioned from a product perspective right now, and they have a lot of transformation over the next 3 or 4 years. And it's even after all these years of transformation, this is a company that you can still only value from an enterprise value to sales perspective. So there's really nothing to like fall back on.
What are your thoughts on NVIDIA?
It still continues to be like a hot rod, awesome situation. I think fundamentals are definitely slowing, and I think the positioning shifts when you look from 2017 out into the longer term. And so it's not necessarily a stock I'd want to be long after 2017. It's so volatile though that I would really, shorting this thing you can end your career in a week. So I think it's the kind of thing that you got to be really careful about.
Yeah. Thoughts on the top NASDAQ stocks with such huge 6-month returns versus expectations into the quarter?
Facebook already told us that they're going to have a tougher sledding exiting this year, so I would take them seriously about that in terms of growth rate, and I'd be, make sure you're comfortable with that. Don't they sandbagged? People think they're sandbagging because they put up great growth rates in Q1, but they had told us that the problems would happen by the end of the year. And if you look at the actual product that they're monetizing right now, the main core product, the Facebook property, the ad load is very high already, and they're shifting into more and more into premium content. So there is a transformation there that could lead to more revenue growth, but for now I think it's heavily loaded. So you're going to see a drop in the growth rate of the core business. It's an amazing company. It's not the kind of thing you short. But it's just one of those things to keep in mind. Google, great. What else? Microsoft, iffy. Microsoft's had a huge run. Most of their products are on the wrong side of the piece of paper of winning and losing in terms of growth rate. So much valuation hinges on the cloud area. Most of Microsoft's cloud is Office 365, so it's just a conversion from on-premise product to cloud product. It's not like the same thing as the AWS revenue, which is all de novo, all new functionality, all people coming to AWS to really replace enterprise core functionality. So part of the Microsoft cloud growth rate is kind of an overstatement. That said, do you short it? I don't know, because in the very, very long run, maybe they have a better toolkit and a better approach to the enterprise than Amazon does, especially if the midsection of a hybrid enterprise is as strategically important as people think today. Microsoft certainly has a better angle for that business than AWS does today.
So you already said earlier, software you see as the most attractive space in tech for the rest of the year. What are your top 3 software stocks, and which would you say is your favorite?
Pass.
Pass? Do you have a price target for Corning?
Over 40.
Over 40. Are you familiar with INTG, which is Integris?
Yes.
And do you have a take on it?
Made a great acquisition in 2013, ATMI. And they've been harvesting the two businesses lined up beautifully together. And they're minting cash flows. I have no idea whether or not the stock is a long or short today, but that space has had a huge run. If you look at MKS, if you look at Integris, if you look at CCMP, if you look at Advanced Energy, all of those stocks have been like quadruples since 2012. And I was invested in those stocks in 2012, 2013, 2014. So, I'm not likely the guy who's going to buy them today, simply because I'm like saw it, did it, invested in it, and now I'm just sort of like I I'm not going to play for the next 20%.
What are your thoughts on Qualcomm?
Complicated. A lot of restructuring ahead. Winning market share on the chip side. Facing uphill battle on the royalty side. Really complicated. At some point, you own Qualcomm because of the NXP asset, and you basically are buying NXP instead of Qualcomm to some degree. NXP plus cash, I guess, has to be your mantra. But Qualcomm management is so bad. It's really hard to get excited. You're basically like, anytime you're going long core Qualcomm, you're hoping that you're catching the trade of the less bad news cycle. So like, for example, now we're in a bad news cycle for Qualcomm, and there's probably a couple more shoes to drop. So wait for those shoes to drop. You get long Qualcomm from a lower price than it is today, and you get NXP merger integration alongside, kind of like less bad news cycle. I mean, that's kind of what you're hoping for with Qualcomm before the next bad news cycle starts again. Because again, we're moving from Qualcomm taking a royalty as a % of the phone price of the phone, which is, let's say, a $700 or $800 phone in some cases, or a $300 phone in some cases. So Qualcomm getting like a 4%, or 3%, or 5% royalty on the price of the phone, to component-based royalties, which might be like a $40 chip where you're paying 10% or 5% royalty on. So the deflation there is enormous, and it's just going to take, it's like 1,000 paper cuts.
And you brought up NXP as a positive for them. You also have two headwinds there. One is the EU is doing their antitrust investigation. We'll see what happens there. There was also a rumor floating around last week of an activist trying to boost the actual price of the acquisition. So, there's still potential for bad news to come for Qualcomm.
Yeah, and I'm happy you raised another point, which this is just like a great example of like how bad Qualcomm management is. They had this offshore tax asset, stranded tax asset, right? Cash that they didn't repatriate so that they could keep their tax rate low. And that asset, was quite large. And it was like cash burning a hole in your pocket. I mean, literally, like, somebody take away that cash from this management team, right? That this is like, help them help themselves. And so they felt this cash burning a hole in their pocket so badly. And also they held it all through the devaluation of cash, right? All the years that interest rates, underlying Fed rates are going down, the value of your cash sitting on your balance sheet, the amount of P&L that you can get from that cash is going lower and lower and lower. And of course, the bottom of that cycle, the lowest point for the Fed funds rate, the lowest point for like, the idea that these companies would never get tax reform and be able to repatriate cash into the United States. This cash is burning a hole. They go and buy NXP because it's like one of like two assets that they can buy using offshore cash. And I'm like, if they had just waited 6 months, they would have had a lot more optionality. That cash would be worth more. I don't know. It's just a classic that Qualcomm has had so far up its own, rear end. It's terrible. Maybe that's a worse management team than Sabre. I don't know.
Yeah. Is Facebook shortable?
Not really. I think it's such a massive free cash flow generation machine. And the core property, even if you are like me thinking about the slowing in the core property, if you look askance to the second tier property and the third tier property, which is Instagram and then followed up by WhatsApp, you see tailwinds. So it's hard. It would be hard to short. And what's great about him is that he continues to throw spaghetti at the wall and see what sticks. He's constantly trying some new products, new monetization techniques, new products, new monetization techniques. It's relentless, and stuff fails a lot there, but they are always following up, and so the chance that they're going to continue to hit success. I mean, can you imagine if they start offering TV for free, so that you can get your TV content that you want to watch, your HBO, let's say, you want to watch Game of Thrones, you're watching it for free on Facebook, you're not paying HBO, Facebook's taking care of that. The benefit is the advertisers can see who's watching this. You can see which of your friends is watching the same show at the same time. You can be messaging them at the same time. So advertisers can see if you're actually involved in the content or if you're messaging about carpools and pickups and whatever it is. You know, I think there's a really interesting model to be made there. Are they actually going to do that? I don't know. Are they going to have success if they do that? I don't know. But there's upside there, and I think betting on Zuckerberg in the long term is probably a good idea. I would say if it's just the core business, yeah, maybe it's going to slow, and so you're going to have an opportunity there. But there's other stuff.
He brings like a lot of really cool projects home with him as well. Like what he tries to develop in his home life that ends up going out to consumers. I think it was last year. He integrated like a Jarvis system for you Marvel fans that are out there in his own home.
Yeah.
Which we all have. It's Alexa and that. But a Facebook version, who knows whether it's going to be hardware based or if it's going to be an integration of the actual, the app itself. He's a smart guy.
Yeah.
And he's like, I agree with you. You can't bet against him.
It's hard to bet against him. Yeah.
One last question. What would you say are the risk factors over the medium to long term for software?
A lot of holes in software. First of all, the traditional landscape for competition has changed. So now if you're a software vendor, you've got to be worried that at some point Microsoft Azure, AWS, and Google Cloud are going to be offering that functionality to their customers either for free or a 99% discount to what you charge for it today. So that's a big change. That's probably the biggest sea change that there has been in software. The second is people are so excited and bullish on the shift to the cloud to subscription models because it gives you greater predictability of cash flows. However, it also commoditizes your R&D because in software you used to complete the product, sell it today for $100 for completed work, and sell access to patches and maintenance updates for another $20 a year. Let's say you sold for $100 today and then $20 per year maintenance fee. But that's all R&D work that's already basically completed. So you're monetizing work that's already done. The dollars have been spent. Today with a subscription, you get access to the ongoing R&D of the company. So you're spending $100 or $20 a month or whatever the number is, and you're getting all the innovation that comes out, all the new stuff. So there's a commoditizing factor there as well. And then the last piece is that we've been in a massive VC investment period for software companies over the last 6 years. Software is extremely low barrier to entry. It's never been lower and easier to start a software company, never been cheaper, I should say. And so there's going to be, for every public company you follow in software, if it's a relatively new age technology, it's got 6 or 7 or 8 or 25 or 150 peers who are companies you've never heard of because they're private, who are all coming up the curve trying to grow revenue, trying to increase profitability, and until this all gets cleaned out, it's going to weigh on these companies' ability to turn the corner on cash flow.
I mean, go on to G2 Crowd or one of those, you can see it. I mean, those are review sites, and you can pick out a simple, it can even be business intelligence, for instance, and the list just goes on and
analytics.
On. And they might be small, but it
Salesforce,
exists.
CRM, anything.
Yeah. So perfect. So that's everything.
Thanks, everybody.
Thank you so much, Ami.
Thanks, Morgan.
Thank you.